Hey everyone, welcome back to Chipstock Investor. Last week, in case you missed it, we talked about neo-cloud company CoreWeave, and today we're going to review a company that we actually did take a small position in, Nebius.
Of course, you probably knew that if you're over on Semi Insider, or if you watched all the way to the end of the last CoreWeave video. I don't think very many did. But anyways, that's where the reveal of Nebius was. But do check out Semi Insider. That's where you can get the info on stocks we plan on buying and selling, and most importantly, why. The research on why we're doing what we're doing, in case that's important to you. Okay. Nebius, the curious case of Nebius.
A little history of Nebius. The index was, amongst other things, was an e-com and ride-hailing service.
At one point in time, if you've been investing for long enough, you probably remember it being called the Google of Russia or something like that.
Of course, when there were sanctions placed after Russia invaded Ukraine, they very quickly split the company up, divested all of the Russian companies on that side, and a new company was born, Nebius.
Well, maybe we should say it wasn't they got the ball rolling on divesting very quickly, but it was a lengthy 2-year process.
You're right. I guess that's true. It just started in 2022, and here we are in 2024 when it finally became what it is today. They announced in August of 2024 the official name change to Nebius and that they would trade on the NASDAQ. And then their re-IPO was in October of 2024.
Trading resumed under the ticker symbol NBIS. There's still questions about this one. There's some interesting stuff going on here. Essentially, what is left over here is the data center assets from the old Yandex. And then because it was an operating business before, there is like a full stack software company built on those data center assets as well. So what they're doing at this point in time is rescaling the business, rebuilding revenue, and of course, figuring out how to pay the bills. But because they're essentially starting from scratch, they've decided to start scaling up into GPUs, specific AI.
Their core business, which we're going to do most of our discussion about, is the AI cloud platform. But they also have a number of other businesses as well and investment subsidiaries. There's Toloka. The AV Ride is an autonomous vehicle startup. And then there's 1010 and ClickHouse. Toloka and ClickHouse are the investment subsidiaries, correct?
Yeah, they're not going to be consolidated in the income statement anymore because those are equity investments, which plays into the balance sheet later on. We don't know how those will play into the capital structure and how they choose to use those assets, but that's what those are. This is an updated slide from the Q1 2025 slide deck, and you can see a lot of expansion there. The data center they own is in Finland. They had the co-location data center in Paris, and then they were working on some data centers in the US. They've expanded those in the last quarter. They also have invested in Israel. And the reason why they're building these data centers is there is customer demand for it. So it's similar to the CoreWeave story. When they have the demand, they will build the data center capacity. Let's just maybe focus on that for now, because the software part of the story, I think at this particular point, is a bit of a distraction. It does represent potential growth in the future, and it is possibly a competitive advantage that Nebius has in the neocloud market. But at this point, this is mostly a data center construction story, which is obviously very capital intensive and is going to create some problems. Why invest in these things in the first place? Here's the AI data center race. Massive growth, and even Nebius on their earnings call called this a race. Straight up, whoever can build this infrastructure the fastest and onboard customers think will win. Of course, what happens in the washout of all of that later on remains to be seen. But you can see the market changing. By 2027, it will have completely flipped, where 2 years ago, AI training was all the rage, but now managing that AI and running that AI, the inference, by the next year or two will be far and away the larger part of this market.
Before we continue, want to give a quick shout out to the sponsor of today's video, FinChat.io.
FinChat is a complete platform you need if you are serious about analyzing businesses you are interested in investing in. Of course, you see FinChat's visuals all the time if you regularly watch our videos, but we also make ample use of FinChat's Copilot, the AI Copilot that helps you get the information you need quickly on the business that you're analyzing.
You can get 15% off any paid plan with the link in the video description or this link right here on the screen, finchat.io/CSI. That's 15% off any paid plan, finchat.io/CSI.
And you can see the Q1 revenue there in the top right came in at $55 million. So big year-over-year growth, but much like CoreWeave, this doesn't mean much right now. That's very, very little revenue, okay? And the reason being is we have a couple $2 billion of capital expenditures that need to be made in data centers just this year alone. So here's the balance sheet as of December 2024, $2.5 billion in cash sitting on hand. However, gross property and equipment, just $1.1 billion. Obviously, if they want to compete with CoreWeave and especially the bigger cloud computing providers that have many billions of data center property and equipment on hand, they're going to need to aggressively ramp up. Let's get to the Q1 actual results.
The ARR ended up at $249 million and their cash on balance down to $1.4 billion.
Okay, but here's where we need to get down to the nitty gritty. First of all, the revenue of 55 million is essentially meaningless at this point. Now, they did say over the medium term, we did get some clarification in the Q&A section of the call. That means, let's say 2028, by calendar year 2028, they do expect to have ramped up to mid-single digit billions of annual revenue. So let's say maybe somewhere between 4 and 6 billion in revenue by 2027, 2028. Okay, now we're getting into something more meaningful. Also, just scratch the adjusted EBIT margin line there in the middle. This is still not really indicative of what the business needs to do right now. So here's what we do need to focus on. We have this very short-term, immediate cash crunch just after one quarter from Q4 2024 to Q1 2025. The balance sheet went from 2.5 billion in cash to 1.4 billion remaining in cash. They had 500 million of CapEx in Q1, which means full year CapEx, 2 billion. We have about 1.5 billion left just in capital expenditures alone, not including all the operating expenses for this business. Same as with CoreWeave. Where is that money going to come from? They have a bit laying around on the balance sheet, right? With CoreWeave, we had basically two options: sell more stock and dilute shareholders to raise cash, raise more debt, but they already had 9 billion in debt already. Those are basically the two options. Nebius has essentially the same two options, but one positive upside is they have no debt currently on balance. So that's good. They also have the equity investments in that Toloka and ClickHouse that they could tap into as well. So there's a bit more flexibility here with Nebius in scaling up. This is still a very small experimental position for us. We're just going to sit tight and see what happens, because this is a very immediate term need, and how management approaches dealing with this cash crunch is going to be crucial, as it is for all the neo cloud providers, because there's just no revenue to work with at this particular stage.